Hello investors and future investors. In today's video, I'm going to show you what I would do if I had to invest $10,000 in today's market. If this is something you want to do and you want to learn how to make an easy $700 in less than a week, then welcome to Investment Gains. Let's jump right into it. Welcome back investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, however, I will show you how, if I were to take $10,000 and invest it right now, today, what I would be doing and the kind of returns I would be getting on this. Remember, before entering any trade, make sure you have an exit plan. Secondly, always do your own due diligence before investing. Now, let's go ahead and get down and dirty with options. So the first thing I would do if I were to invest $10,000, I would go and pick up one leap on AMD. So let's go ahead. We're going to open up AMD. Here we are on AMD, and we're going to go ahead and scroll down and try to open up the AMD options. To get that done, we're going to go to trade AMD options in the bottom. Now, we're going to make sure it says buy and call, and then we're going to choose our strike date. Strike date in this case is going to be very important. So I'm going to go ahead and I'm going to choose the strike date of September 19th, 2025. Now, what I'm going to do is I'm going to go ahead and select the strike price below the current share price. And I would be going with the 120 strike price, and that's going to cost me around $26.35. In the real world, that's going to be equal to $2,635. Each option contract is multiplied by 100 shares. Now, this is part one of what I'm going to do, and that's going to take away $2,600 away from my $10,000. Okay, next what I would do is I was going to go into a different stock, which is going to be Micron Technology, ticker MU. So I'm going to open up Micron, and once again, I'm going to go ahead and open up the option chain. So let's go to trade MU options. Okay, now we're on MU options. We're going to do the exact same strategy. We're going to go to buy, we're going to go to call, and then we're going to select the strike date. Just for the purposes of this video, let's go with the exact same strike date, which was September 19th, 2025. And once again, we're going to go ahead and choose the strike price below the current share price. I will be going with the $95 strike price, and that's going to now cost me $28 or $2,800. Once again, each option contract is multiplied by 100 shares. So now my $10,000 is down $2,800. It's also down $2,600. Now, these look extremely simple, but if you guys want to know my rationale for choosing these different strike prices, the chance of profitability, I have several videos on the station that shows you my criteria for choosing these strike prices. Feel free to go over it. I will, however, try to link the video in the description or somewhere to the top. So now my $10,000 is down. Now, stay tuned. There's lots more to come. Now, if you are getting any value from this video, now would be a good time to go ahead and like the video and also subscribe. So now you probably have around less than $5,000 left. So let's go ahead to our different strategy. For the next strategy I'm going to be going with none other than Marathon Digital, ticker MARA. Okay, so the strategy on Mara is going to be different. So once again, we're going to go ahead and we're going to open up the options chain. So let's go to trade Mara option. So now the option chain is open. Remember, this one is going to be a different strategy. So I would go to sell and also to put. And then I'm going to go to a strike date of just, let's do December 27th. And then now I'm going to go ahead and once again, I'm going to choose my strike price below the current share price. Now I will be going with, let's do the 23.5 strike price. Now, once again, this does look like it's random, but trust me, a lot of thought goes into choosing these strike prices. Now, I'm going to go ahead to continue, and I'm going to change up here to 2 contracts. So that's going to cost me now about $2,046. This is going to be exactly $4,700. So now that takes off my whole $10,000. Remember, one leaps option on Micron Technology, one leaps option on AMD, and 2 cash secured puts on Marathon Digital. So now that we spent our entire $10,000, how are we going to make consistent revenue? Well, I'm glad you asked. So number one, the first amount of revenue we're going to be making is going to be off our cash secured put with Marathon Digital. And that's going to work out to be $192. So right away, as soon as you do this, you're now able to get consistent revenue. So right here, let's just round it off to $200. Now let's go ahead. We're going to go back to Micron technology, MU. So remember, we did purchase a leaps option on Micron, which now gives us a controlling interest of 100 shares. What that does is that's going to allow us to sell covered calls on these. So for that strategy, we're going to go to sell and we're going to go to call, and now we're going to go ahead and choose our strike price once again. In this instance, I'm going to go above the current share price, and I'm going to be going with the $120 strike price. And for that, I'm going to be paid $3.20 or $320. Now, $320 plus your $200. So now you're roughly at $500 in gains only. Now, once again, this looks like it's quite simple, but it's not. If you guys want to see my criteria for choosing these strike prices, my chance of profitability, just go ahead and look for the video right before this. I went into detail of how I chose this actual strike price. So now we have $500 in gains on our $10,000 initial capital. So we're going to go and do one more trade right now, and that's going to be with AMD. So here we are back on AMD option chain, and we're going to do a similar strategy, which is going to be selling covered calls once again. So let's go ahead to sell, let's go ahead to call, and now we're going to choose the exact same strike date. We're going to go with December 27th. And then now we're going to do the exact same thing once again. We're going to choose our strike price above the current share price. And I will be going with let's go with the $135 strike price. Now, for the $135 strike price, that's going to pay me an additional $1.30 or $130. So let's do a rough calculation. Now, my premium is up to around $600. $200 for the cash secured put on Mara, $300 on the covered calls for Micron Technologies, and now $130 for the covered call on Mara. So that's roughly $600. What you're going to do now is you're going to divide your $600 by your $10,000 you spent, and that should give you around 6%. 6% is not very risky. Now, let's just say that one of these trades were to go tits up. No problem. I'm going to show you what's going to happen. So we're already on AMD, so let's use that. So we do have a controlling interest of AMD in which we bought a leaps option. The leaps option we bought was at the $120 strike price. And if AMD now were to go to if AMD were to go now to $135, all you're going to do is subtract $135 from the current price of $127, and that's going to give you $8. So if AMD were to hit $135, you will be making an additional $800 in addition to your $100, which is going to give you $900 in 1 week. Now, here's the bad thing. The bad thing is you're going to lose your leaps. And the good thing is you're going to make $900. So this strategy is what I always refer to as a win-win strategy. So I would like to know from you guys right now, if you guys were to invest $10,000 in your money right now, what strategies would you be doing and what stocks would you be doing? Now, until the next video, keep pushing your investment.